Good morning, everyone. We're here today to delve into the key drivers shaping returns within the technology sector. Over the past 5 years, tech has been a dominant force, but its journey hasn't been without significant volatility. Our analysis, spanning from April 2021 to March 2026, provides a statistical and fundamental breakdown of what truly moves these markets. We'll explore the quantitative levers and the underlying structural forces at play. This comprehensive review will equip us with a clearer understanding of the tech landscape. Let's start by examining the sector's performance over this period. The tech sector's journey over the last 5 years has been remarkable. Yet it came with a cost. While the Nasdaq 100 ETF, QQQ, delivered an impressive 95.5% total return, it also experienced a peak drawdown of 35.6%. This significantly outperformed the S&P 500's 77% return. But QQQ's annualized volatility was notably higher at 24.7% compared to the S&P 500's 22.3%. This highlights a critical trade-off. Superior long-term returns in tech often accompany higher volatility and deeper drawdowns. Understanding the forces behind these swings is crucial for investors. Now, let's look at how we've modeled these drivers statistically. Our statistical model reveals a compelling insight. 2 macro variables, Treasury yields and market fear, account for a full 50% of the monthly variance in tech sector returns. This is a highly significant finding, with our model achieving an R-squared of 0.50 and a p-value below 0.001. Specifically, changes in the 10-year Treasury yield and the VIX, our measure of volatility, are highly significant drivers. Interestingly, direct CPI inflation and the federal funds rate, while important, show no direct statistical significance in explaining monthly tech returns. They influence tech indirectly, through other channels. This model provides a robust framework for understanding the primary quantitative levers. Let's unpack the first of these key drivers. Treasury yields. Treasury yields are, without question, the valuation engine for the tech sector. Our analysis shows that a mere 1% rise in the 10-year yield correlates with a substantial 12.5% drag on QQQ's monthly returns. This makes it the strongest single driver in our model. Tech stocks are inherently long-duration assets. Their value is heavily weighted towards future earnings, often 5 to 15 years out. Consequently, higher discount rates, driven by rising yields, compress the present value of these distant cash flows far more severely than they do for value stocks. We saw this play out dramatically in 2022 when yields surged, and QQQ fell nearly 30%. Conversely, stabilized yields in 2023 fueled a strong rally. Investors must monitor the 10-year yield as a primary real-time indicator of tech sector risk. Now, let's turn our attention to the second major driver, market volatility. Building on our discussion of yields, market volatility, as measured by the VIX, is another critical factor. Every 10-point spike in the VIX is associated with a significant 24.6% annualized headwind for tech sector returns. This inverse relationship, with a correlation of -0.548, underscores tech's high beta. Tech stocks consistently fall harder and faster during risk-off episodes. Historically, a VIX sustained above 25 has coincided with the worst monthly returns for the NASDAQ Q100. High valuations in tech are the first to be questioned during uncertainty, leading institutional investors to reduce high beta exposure. The 2022 bear market, with the VIX consistently above 25, perfectly illustrates this dynamic. Next, We'll examine how inflation, while not a direct driver, acts as an upstream trigger. While volatility amplifies tech sector swings, inflation acts as the upstream trigger, setting a critical chain of events in motion. Our analysis shows CPI inflation has only a negative 0.18 direct correlation with tech returns, meaning it's not the direct cause of tech's struggles. Instead, it's the policy response to inflation that truly impacts the sector. When CPI rises, the Federal Reserve typically hikes rates, which then causes Treasury yields to surge. This increase in discount rates compresses tech valuations, leading to price declines. The 2022 experience is a prime example. CPI peaked at 9.1%, leading to 11 consecutive Fed rate hikes, and QQQ subsequently lost 35.6% peak to trough. The key takeaway here is to monitor inflation as a leading indicator for Fed policy, not as a direct driver of tech returns. Now, let's shift our focus to a more structural driver that can, at times, override these macro headwinds: AI monetization. The generative AI boom has proven to be a powerful structural growth engine, demonstrating that fundamental earnings catalysts can indeed override significant macro headwinds. We saw this clearly in 2023, when the AI narrative drove QQQ's impressive 57.5% recovery. Mega-cap tech companies like Microsoft, Nvidia, Alphabet, Meta, and Amazon were at the forefront, with Nvidia alone seeing earnings grow over 400% year-over-year due to insatiable AI chip demand. Looking ahead, our forward projections for 2026 to 2027 highlight the critical role AI monetization will play. In a bull case, continued AI capex and expanding software margins could drive a 32% return. However, a bear case, where AI return on investment disappoints, could see a 16% contraction. The central question for investors is whether current AI revenue growth can truly justify the elevated valuation multiples we're seeing in the sector. This brings us to another critical macro factor: Federal Reserve policy. Federal Reserve policy has been the single most consequential variable for tech sector performance since 2021, acting as the macro policy anchor. The Fed's rate cycle, from near zero to 5.33% and back down, directly correlates with significant shifts in QQQ's performance. For instance, near zero rates in 2021 saw QQQ gain 29%, while aggressive hikes in 2022 to 2023 led to a 35.6% peak drawdown. Conversely, the period from September 2024 to March 2026, marked by rate cuts down to 3.33%, fueled a strong rally. Our forward-looking scenarios underscore this impact. A bull case with 3 or more cuts to 2.75 to 3.00% would drive multiple expansion, while a bear case with rates holding or hiking to 3.33 to 4.00% would lead to multiple compression. Understanding the Fed's trajectory is paramount for tech investors. However, we also need to consider the less predictable, but equally impactful, tail risks. Geopolitical and regulatory risks represent the highest impact, yet lowest predictability factors for tech sector returns. These are the tail risk modifiers that can rapidly alter the macro environment. We're talking about issues like semiconductor export controls, which directly impact major players like Nvidia and AMD, or the potential for new tariff escalations that could reintroduce inflationary pressures. Antitrust scrutiny against tech giants like Alphabet and Apple also creates significant headline risk and the potential for structural changes. Furthermore, emerging AI regulations in the EU and US could impose substantial compliance costs. These events are low frequency but high impact, capable of shifting the entire landscape. For example, tariffs leading to inflation, which then triggers a Fed policy change. They are also the primary driver behind the elevated volatility assumptions in our bear case scenario. Now, let's bring all these drivers together into a unified framework. We've just reviewed 6 distinct drivers of tech sector performance. Now, let's synthesize these into a unified framework. Understanding their relative importance, we've established a clear hierarchy. The 10-year Treasury yield and VIX are the top 2 quantitative drivers, directly impacting returns with statistically significant coefficients of -0.125 and -0.246, respectively. Below them, AI and earnings fundamentals act as the structural growth engine, while Federal Reserve policy and CPI inflation serve as critical macro and leading indicators. Geopolitical and regulatory factors, while less predictable, represent potent tail risks. This hierarchy underscores a crucial insight. Inflation itself isn't the direct enemy of tech stocks. It's the Fed's policy response to inflation that triggers yield surges and subsequent repricing. This framework provides a robust lens through which to view future market movements, which we'll explore in our 12-month outlook. Building on our driver hierarchy, we've developed a 12-month scenario outlook, outlining 3 distinct paths for the tech sector. The critical determinant here is inflation. Whether it remains tamed or resurges will dictate our trajectory. Our bull case, driven by continued AI momentum and aggressive rate cuts, projects a robust 32% return for QQQ, with a 90% probability of gain. The base case, our most likely outcome, anticipates steady normalization with CPI around 2.5 to 3.0% and Fed funds at 3.00 to 3.33%, yielding an 8.3% return. Conversely, a bear case, characterized by stagflation and higher rates, could see a 16% decline. These scenarios, derived from 10,000 Monte Carlo simulations, highlight the sensitivity of tech returns to macro conditions. So, what does this mean for your investment strategy? In conclusion, our analysis provides 5 actionable takeaways for navigating the tech sector. First, always watch the 10-year Treasury yield. It's the primary real-time indicator for valuation risk. A sustained move above 4.5% would be a significant headwind. Second, a VIX above 25 signals elevated risk, historically coinciding with the deepest tech drawdowns. Third, don't confuse CPI with the real risk. Inflation matters as a leading indicator for Fed policy, not as a direct return driver. Fourth, AI monetization is the structural wildcard. Its ability to convert CapEx into earnings will determine the market's direction. Finally, our base case of an 8% return is the most likely outcome. With CPI near 3% and the Fed at 3.33%, we're in a higher for longer normalization phase. Not a crisis, but not a boom either. Thank you.